Welcome to Earl Stewart on Cars.
Insurance is a very profitable thing to the people that sell insurance. The reason the insurance companies make so much money is real simple, is they charge you far more premium than they pay out in claims. I mean, that sounds like a no-brainer. So remember that when you're buying insurance. It's kind of like placing a bet. You're betting when you buy insurance that you're going to lose. You're betting that you're going to wreck your car. You're betting somebody else is going to hit your car. You're betting you're going to be injured. Any insurance you buy, you're really betting against yourself. So there's a lot of things to take into consideration. My philosophy when buying insurance is if I can afford to pay if I lose, if I'm in an accident, if I dented my fender and it cost me $500, I can afford to pay $500. So I'm not going to pay the insurance company a premium to cover the first $500. So I'll go with a $500 deductible. Or maybe I can stand $1,000, so I'll go to a $1,000 deductible. Of course, the higher your deductible, then the lower the premium. Now, there are a lot of people out there that can afford to fix any car. I mean, they if it's a total, they can buy another car. In which case, they just don't buy collision insurance. They save a ton of money. You know, your big fleets like Hertz, Avis, National, all your big rental companies and leasing companies, they're all self-insured. When you self-insure, I tell some people, you know, if your insurance premium is $300 a month, and you take $300 a month and you invest it or you put it in a savings account, and you're self-insuring there. And if you had done that your whole life, you would have a lot of money like Warren Buffett does because you'd be making money off you insuring yourself. And then when you had a claim, if you had that kind of self-discipline, you draw upon that savings account or investment account and you pay for the accident. But there's no right answer to how much insurance you should carry in terms of auto insurance. You got to go the minimum because if Bank of America is financing your car, they're going to tell you what you have to have. But if you don't have that, you're paying cash for your car, then you just have to decide. The other thing I say to customers and people that ask me about insurance, I say insurance is primarily about peace of mind. And some people who don't need the insurance, people who can afford to repair their own car, there's something about having to pay out of their own pocket that bothers them, and they'd rather have the insurance, and that gives them peace of mind. And then they think, well, if I have an accident, I'm not going to have to pay for it. Even rich guys don't like to pay for things. I mean, they'd rather not pay, and so they think, and it's kind of like self-delusion, in my opinion, by paying the insurance company, somehow you're not having to pay for the accident. Well, believe me, you paid for the accident many times over, because if your driving life is, 50 years, if you've been driving for 50 years and buying car insurance for 50 years, you have paid out a whole lot more money than you ever got back in on claims. I mean, that's just the way it is. Peace of mind, that's what you're doing when you pay that premium to the insurance company. If you're driving a 10 or 11-year-old car, and it's got a cash value, a market value of maybe $1,000, it makes no sense to insure that car at all. The insurance company's going to replace the car for you, but you don't want the car replaced. You probably want to buy a new car anyway. And for the replacement value of that old car you're driving, you might be able to scrape together a down payment, but you're not going to be able to buy another car. As your car depreciates in value, if you have the right to do so, and you are not bound by the terms of the lender, you should reduce the insurance based on the depreciation. I think if you go back and get your pencil and paper out and look at the number of times you've collected from your insurance company and look at the number of premiums you paid and do the arithmetic, you'll say, why have I been doing that? Insurance companies are so bad about passing along rate reductions to their good customers. That shows you how much they really appreciate you. If you've been with a particular company, State Farm or Allstate, for 10 or 15 or 20 years, you should check with them every year because they will lower their premiums and give them to a brand new customer and charge their old customers the higher premiums, even if you have a good driving record. So if you've been with a company for 3 or 4 years and you haven't checked their rates recently, check with them because they could have come down. And when they think they might lose you to another insurance company, you should shop and compare. They'll tell you immediately what their new lower premiums are.